This is TreppWire Week in Review for the week ending September 1st, 2023. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, head of CRE and advisory services, and Stephen Bushbaum, research director. This week, we saw the late August stock market come back, with stocks rising for 4 straight days as batches of economic reports came in. The number of available jobs in the U.S. shrank for the third consecutive month. New consumer spending data showed that Americans are still spending without cause for concern and hinted at the easing of inflation that the Fed has been looking for. Lonnie, there was a positive theme this week, but hints of weakness could turn bad news is good news into bad news is just preceding more bad news.
Well, I have to commend you, Haley, on reading that intro because that's a tongue twister. Obviously, stocks rallied and bond yields fell on Tuesday following disappointing economic data that came out. This was a pretty busy week for some reports. So we'll kind of dive into those. We have the JOLTS report, we have the consumer confidence index, and we had PCE that came out in addition to some jobs reporting. But one of the items you highlighted in the intro that I think is pretty compelling is that the consumer spending data shows that consumers are still spending, as you say, without cause for concern. Stephen and I just did a Market Pulse webinar earlier today, and he was talking about the savings rate post-COVID and how, Americans have basically depleted their stimulus-fueled savings that they had coming out of COVID. And I think the consumer spending, while maybe hasn't raised red flags yet, we're seeing credit card balances, car payments, delinquencies on other non-secured debts starting to rise. It'll be interesting to see if that spending can be maintained when people max out their credit cards and their savings are completely depleted. So that's something that maybe wasn't specific to this week that I think is relevant for us to be keeping an eye on. If we get back into this week's data, the JOLTS numbers, which is a job openings and labor turnover survey, those numbers came in really low relative to expectations, and previous numbers were also revised lower. So, one of the major concerns we've had on the podcast and talked through is that the overall employment rate has been running too hot. And this is something that Jerome Powell has been talking about, that it's just been stubborn. Employment has been really hard to get to move. The last several months, JOLTS has remained really, really high. Maybe this is an indication that we're starting to see the labor market loosen up a little bit. I think you're also hearing a different tone from CEOs around the office sector on return to work, basically stipulating that if people don't come to the office, they're not going to have a job. Amazon CEO effectively said that this week. So it feels like there's maybe some stiffening up from the CEO's position on the employment market, maybe some softening in terms of the actual numbers. Consumer confidence came in lower. They were at 106.1 from a downwardly revised 114 as reported in July. So we'll see what that looks like on the go forward, but not a great sign. Although if you look at that over the last 18 months, it's been really low. It's been really high. 106 is not alarming to me. And then PCE, which we refer to as the preferred inflation gauge for the Fed, it ticked higher, but there's some commentary in Barron's this week that basically says that even though prices increased on an annualized basis in July, they don't think that it necessarily means there's going to be significant change in the interest rates. And I think Powell said that at Jackson Hole, that basically we're in higher for longer. I think that was reiterated. There's potential for increased rate hikes, but nothing imminent on that front. And then lastly, job growth slowed sharply to 177,000. That was reported for August, which was significantly below ADP expectations. And so I find this one kind of interesting. I usually do the jobs update on the pod. And so for the last several months, the ADP numbers have come in significantly higher than expectations. But then it seems like without fail, as soon as that number blows over and everyone's looking at something else, they quietly revise those down to something more realistic. This month, though, they came in lower than expectations. So I wonder what will happen going forward on that. Are they going to revise those numbers up? Not super confident what we're getting reported from those on a month-to-month basis. So I know that's a lot, Stephen, but I'd like to hear your comments or your thoughts on this week's macro market.
So it definitely feels like we've got some unease creeping into the market from what you've seen, mainly in bonds, right? Bonds kind of predict what's coming next. Stocks reflect forward pricing and are a little bit less clear indicator of what's going on with the fundamentals. So last week's Jackson Hole Symposium had some really interesting commentary. Nella Richardson, who's the chief economist at ADP, was talking about some of the stuff that they're looking at and research they're doing in-house. And I keep hearing this over and over and over again from a number of economists, a number of news outlets, that there's just two Americas, and part of it's just flat on their back. Tom Keene at Bloomberg Surveillance, I can't tell you how many times I hear this from him per week, but he'll say, part of America is flat on their back. They're really struggling right now. And so when you think about what the Fed maybe is concerned with, if you're just looking at some of these wage growth figures, you'd think, gosh, 5, 10, 12%, that's kind of concerning. Maybe we do have some more upward pressure on inflation. But Nella Richardson at ADP pointed out something that was so simple. You're like, thank you, finally, somebody raised this excellent point. Well, let's think about what that means on your typical, say, average or medium wage in the US. Is $500 really a threat, or even $1,000 additional? Really a threat to inflation? Come on, Fed. Let's think about this rationally. So if we step back from this and think about what's coming down the pipeline with student loan payments restarting in October and what we've been seeing in the data, and in particular the consumer confidence, that was one that stood out to me that maybe in isolation wouldn't have been anything significant, but in combination with what we're seeing in delinquency rates, student loan payments restarting, the drawdown on savings, and then comments from, like Manis about Taylor Swift tickets and how expensive they gotten. Sorry, Manis, had to do it. But, seriously, the U.S. consumer spending patterns have changed. And so will we start seeing this materialize? We've, I think, talked a little bit about rolling recession. So maybe we'll start seeing some of the consumer spending data roll over this fall as really some of the tightening in credit conditions comes in. Because again, to think about this in simple terms, 70, 80% of the US has a mortgage rate below 4%. They're not going to move that frequently, right? The average household duration, how long they stay in one place, is 5 to 10 years. And corporations have done the same thing, pushing out the maturities. So their fixed interest is really low. They have positive carry on their cash, which just means they can earn, say, 5.5% in short-term yields if they're investing wisely. But heck, even at 4.8%, that looks pretty attractive if you're only having to pay out 4% on your fixed rate bonds. Right? You have positive carry. That's what that term means. And so it's going to take some time for these rolling maturity schedules to ultimately have the Fed sponge work to suck the money excess money they want to get out of the economy out. So it's just going to take some time. And I guess if I was going to caution the Fed with one thing, I would say patience. And, fortunately, you're hearing this from them is patience is, I think, appropriate right now, that the risks are more balanced and we don't want to take any 1 month's inflationary print or strong job or strong wage numbers as overdoing it, right? Because the risk of tightening into a recession, I think, is becoming more real.
Yeah, especially if you factor in some of the news coming out of China the last couple of weeks, that could have some real macro headwinds for the U.S. economy. So I definitely agree, Stephen. I think the Fed's going to take a more cautious approach relative to their actions going forward. But we're certainly in the higher for longer. As you talked about the mortgage rates being really low for a large majority of homeowners, it kind of reminds me of having a positive leasehold interest in an existing lease structure where maybe your current rent's 40% below market, and there's some upside for you there in a sublease. We're seeing the opposite of that in today's market, but it's interesting how those cycles play out both in residential and the commercial landscape.
So something else we didn't get to last week was the news about Rite Aid potentially filing for bankruptcy.
Yeah, so for those that missed it Friday, the Wall Street Journal reported that Rite Aid could file for bankruptcy over the next few weeks. The firm is facing liabilities related to its sale of opioids. And what triggered this was that they failed to reach an agreement in various courts. This is a big mess. And so the liability concerns are just continuing to mount. And eventually, it looks like this is all but a done deal with Rite Aid basically being forced into bankruptcy. So we put together a list. We call them loans in the spotlight. These are loans with exposure to Rite Aid as a tenant. What we have is 93 mortgage-backed securities that have exposure in some way, shape, or form to Rite Aid as a tenant. That covers 124 loans across 240 properties with a total current balance of 1.47 billion. And so that's 1.47 billion in loans outstanding. In total, obviously Rite Aid typically has a fairly small footprint. So if you think about the economic damage if Rite Aid were to reject leases as part of this bankruptcy strategy, which is very, very common, the damage should be fairly minimal, but this is still a very wide-reaching bankruptcy that is still evolving.
So if we take this in the context of some of the macro stuff we just talked about, Stephen, you could list off 2 or 3 of these large-scale retailers over the last 4 or 5 months that have had bankruptcy. You have, start off with Bed Bath & Beyond. You had the Christmas store, the Christmas tree stores. You had WeWork, which is office. Now you have Rite Aid. So, there's usually a correlation between broader recessionary type of forces and an uptick in bankruptcies. And this is something that hasn't had a huge amount of publicity at this point, but I would suspect as these things continue to tighten and people start dealing with the implications of this higher rate environment, you're going to see some more broad-based bankruptcies. Now, this one is tied to a specific challenge that is unique to this, but it's still predicated on the fact that now the borrowers in those loans are going to have a harder time potentially filling some of that space, refinancing their loans, et cetera, et cetera. So this is one that, while maybe small in footprint in the actual centers themselves, could have some, bigger downstream implications for the broader market.
And it'll be interesting to see if we get any of that positive spin where, crisis or disaster can breed opportunity. So with Bed Bath & Beyond, what we saw was that was actually a net positive for some landlords, and that they're able to subdivide space and ultimately come out better off in the end, because there's not a lot of retail space being constructed in the suburbs, and that's where a lot of these properties were and a lot of the rent growth. So it'll be interesting to see if we get any of that same positive movement with Rite Aid. Granted, the space configuration and typical locations are very different than what you get with Bed Bath & Beyond, but still something to look out for, especially since we've seen a lot of positive momentum and opportunity in the restaurant segment.
This week, we also released our CMBS delinquency report, and we encouraged readers and listeners to parse and analyze the data very carefully. So let's break it down for our listeners now.
So the CMBS market saw a modest reprieve from surging delinquencies in August. Really, the improvement came from a decline in the hotel delinquency numbers. What we saw in August was that the lodging delinquency rate went from 5.85% in July. It ticked down to 5.31% in August. So a really good, strong movement down in the lodging delinquency rate, and that helped pull down the overall headline rate. But it's not like we can go popping corks, I think as Mana said, because if you look deeper across property types, what we saw across industrial, multifamily, retail was that those are still elevated rates, and then office continued to tick higher. And importantly, if we do a little bit of tinkering with the numbers here, because the delinquency rate includes non-performing maturity balloon loans. But if we want to think about this as just kind of a broader problem, loans are reaching their maturity date and are unable to pay off. We have some that end up still making their monthly mortgage payment. Those are the performing maturity balloons. And then another portion of loans that stop making their monthly mortgage payment. And those are the non-performing maturity balloons that end up in our delinquency numbers. The performing are excluded. So if we were to include those loans that are past their maturity date, but still current on payments, you would have seen this overall rate continue to tick higher, and things would really look like it's on that troubling trajectory that we've been talking about the past couple of months.
Yeah, I think the delinquency numbers, you're going to see a little ebb and flow given where we're at in the cycle. Some things, temporarily come off of the delinquency list because they work out some sort of a modification, or there's something that allows them to get back current. But I would suspect that we continue to see an upward trajectory here. You mentioned a little bit some of the multifamily stuff, Stephen, and we had talked about this on the Market Pulse webinar. While it's not like headline worthy on the delinquency, there's a lot of activity in this space over the last couple of weeks.
Within the multifamily space, you have a lot of recent vintage loans that have been underwritten, very optimistic expectations in terms of cash flow growth. And so what we're concerned about seeing in the delinquency numbers is just a continued tick higher. So one of the trading alerts that we had come out this week was for a large San Francisco multifamily portfolio loan. It's called the Veritas multifamily portfolio loan. So this came out Wednesday night from the San Francisco Chronicle's Roland Lee. They reached out ahead of time, this was a really big loan, $940 million in debt. So back in May, the San Francisco Business Times reported that the loan was being offered for sale by Eastdil Secured. This loan backs two 2021 CMBS deals. So CMBS investors are obviously going to be treading very carefully when they're trading these because this is going to have major implications in terms of cash flow timing. So last year we wrote this loan was facing imminent default and the borrower was not going to be exercising their extension options on the loan. Collateral is made up of 61 multifamily properties in San Francisco. And this is ultimately, I see it as a win for a loan of this size to have a buyer come out and for this thing to trade.
If you're affiliated with Ballast Investment, we'd love to hear from you. We'd love to get the details on this. We'd love to see what is the reposition plan, what is the overall plan here. Obviously, a reset in basis helps. But if you look at these loans, they went in at origination at 64% loan to value, occupancy at 75% with debt service coverage just over 1. But occupancy has been down. Loan to value obviously went the other direction, and debt service has been less than 1.0 since 2021. So while this is maybe a good buying opportunity, I'd really love to see kind of what the strategy is heading into this, because for the last couple of years, these properties have really been struggling.
And we saw several apartment comps this week. Lonnie, walk us through those.
Yeah, so a lot of apartment activity, as we mentioned. And so we picked out a couple of stories that we'll detail here this week. This first one is for a San Antonio apartment complex down in Texas. This story comes from Multi-Housing News. It is a 416 unit complex called The View at TPC, sold for just about $71 million. The sales price represents about $170,000 per unit. The buyer on this transaction was an affiliate of CRE Capital, and this property was formerly known as Cortland View at TPC. Last time this property traded was 2016, and it looks like the sales price per unit then was about $155,000 a unit. So moving on to the next one, we had a story out of Arlington, Virginia. This was another multifamily sale. In this case, not much appreciation on the current sales price compared to the last transaction in 2016. This story comes from the Washington Business Journal. Avalon Columbia Pike Apartments sold for a total of about $105 million. Sale comes out to just under $400,000 per unit. The complex is comprised of about 269 units and will be renamed after the sale to Jasper Columbia Pike. They were acquired by Avalon Bay back in 2016 for $102 million. This is an interesting, very typical complex for the Arlington, Virginia area, because it does have some street level retail. And the buyer for this transaction was Penzance. As of right now, that property does not back any CMBS debt. And then lastly, we had an Orlando area multifamily comp. This is according to the Orlando Business Journal. The Alta Cypress Apartments, this is in Longwood, Florida, sold for about $90 million, $263,000 per unit. This is a 342 unit property, and this is a fairly new construction. This property was recently completed and sold by the developer Wood Partners. Buyer on this deal is rumored to be Journey Capital Real Estate Partners. So 3 quick hits on some multifamily deals. Nothing too dramatic in terms of sales price per unit overall, headline sales price, but just some good stories, some good comps given where we're at in the cycle and some of the negative connotations that some multifamily markets, specifically in the Sun Belt, have experienced over the last couple of months.
And let's move on to the office segment. We have a lot of stories this week, and they cover a lot of different topics, from sales to value reductions to loan news. So let's jump into those.
First up is an Atlanta office that sold for a sizable discount, $213 per square foot, 16.7% discount to the 2016 price. I will say, when I think sizable discount, we've seen a number of discounts in the 40 to 60% range. So, relatively speaking, this isn't as negative as some of the other ones we've talked about. So according to the Atlanta Business Journal, 3 Ravinia in Atlanta has sold for $41 million. Article notes that the property is the tallest in Atlanta's Dunwoody neighborhood, and it's home to IHG Hotels. The buyer of the 820,000 square foot office is Estine USA. The price equates to $213 per square foot, and they assumed a $115 million loan as part of that sale. The seller was Blackstone, which had acquired the property for $210 million in 2016. So again, that's a 16.7% markdown over 7 years.
Stephen, on that one, we keep using the term discount on these offices, and it reminds me of those State Farm commercials that used to have like Aaron Rodgers or whatever, and it was like the discount double check. I wonder if we should start something like that for the office sector, because it seems like these transactions are, piling up on the discount side of the ledger.
I like it. And maybe we can go one step further. We've seen some professional athletes transition to media. I mean, if Aaron Rodgers needs any plans for after retirement, maybe we can get him over at Trepp.
Well, he's up in New York now, so maybe Haley can work on getting him on the pod.
Boots on the ground at MetLife. I'll be there.
Another San Francisco area office sells for well below pre-pandemic values. According to the San Francisco Business Times, One Concord Center at 2300 Clayton Road in Concord, California, has sold for $40.5 million. The sales price equates to $110 per square foot. The seller was Bridge Investment Group, who acquired the 369,000 square foot office in 2017 for $70.45 million. Article notes that Bridge invested $20 million into the asset. The buyer was California Capital and Investment Group. The property does not back any CMBS debt.
Yeah, this is another one of those where, we've seen a couple of these buildings transact where the buyer bought it near the peak or right before the peaks in the cycle, invested a ton of capital into improving the building, trying to reposition it, and then sell it for effectively 50% of what they have invested in the property. Really tough deal for the sellers in this transaction. But again, I know the challenges that are going on in San Francisco. We've heard about the life safety. We've heard about all these things. We've seen the transactions. But if you're buying a San Francisco office building for $110 a square foot, I'm bullish on that. I mean, I think that you're probably in a position there at that basis to where this makes sense and you can come out looking really good in 5 to 10 years.
I'm with you. I'm a big believer in the contrarian trading strategy. Certainly, it's at least fun to talk about. And this is exactly what you're getting here, where you're seeing some people that are looking at the market and saying, well, I get it. It's really tough out there. Lenders are either just saying they're not lending on office at all. I'm hearing talk of some investors in CMBS bonds putting a limit on how much office exposure is okay, even if they're buying the AAA rated senior bonds. 25-30% office exposure is their limit. And so, if somebody's walking away from the market wholesale, that just creates opportunity. And certainly with the return to office stories that we were talking about on the Market Pulse webinar earlier today, I have to wonder, are we close to the inflection point, and at a point where, if you have the stomach for these type of investments and a long-term strategy, and you're picking really good assets, good locations, it seems like a good strategy. I like it. So next up, we have more sublease space coming to the Chicago suburbs. According to Crane Chicago, tech firm CDW is looking to shed more than 200,000 square feet of office space via sublease. The firm is located at the Tri-State International Office Center in Lincoln Shore, Illinois. The lease runs for another 5 years, and the property doesn't back any CMBS, but the news would be more stress on nearby offices in a market that's already been hit by a number of other sublease stories and is kind of facing a situation similar to San Francisco in terms of just how bearish it seems like the news has been hitting lately.
Yeah, so Lincoln Shores, this is the first time we've talked about them having some sublease challenges. And so CDW, 200,000 square foot is a pretty good size swath that they're trying to make available. 5 years left on the lease. Definitely something to keep an eye on there. I mean, I'm optimistic and hopeful that we're going to start seeing things turn around in Chicago, but stories like this just continue to hit the top of the headline. I mean, it's like every day you turn around, there's another building, another tenant, another whatever that's either traded or put sublease space out. And it's not limited to just Chicago. So I'll take this last story, Stephen. We have the top tenant in the St. Louis office, which is going to vacate. This was, according to servicer commentary, $13 million plus or minus Gateway Tower loan. The top tenant says they're going to be vacating at the end of the year, which is just another blow for this asset, which is a 215,000 square foot office in St. Louis, Missouri. The top tenant is KMOV TV. They occupy about 24% of the space. and their lease ends in December. They've negotiated a payment of about $550,000 to leave the interior build out of the space in place. And the loan is about 2% of the collateral behind a 2019 deal, but this is part of CMBX 13 and CMBX 14. There is some silver lining here, though. The lease for the fourth largest tenant was up at the end of August, and there's commentary that says a lease extension is out for signature. It's really interesting here. I've been pulling some data in St. Louis. I was trying to fulfill a couple of requests that came in. There's been almost zero office activity in St. Louis, even predating COVID. This is a market that has been fundamentally broken from an origination perspective, an investor target market, et cetera, for some time. And unfortunately, with this story and others, it seems like the existing deals that are out there are still struggling and probably will for some foreseeable future.
Yeah, Lonnie, just to echo that sentiment, you're just seeing some really major structural weakness here. It's becoming just a sleepy metro that's getting zero traction. So until we really see some big moves in terms of businesses hiring, relocating, something, anything, it feels like there's nothing bright on the horizon here, which is tough because I love St. Louis. Fantastic pizza.
So one more in St. Louis. I said that was the last one, but I jumped the gun there. I was like a sprinter in the world championships this week that came out of the blocks a little too hot. Stephen and Haley are laughing because they know I would never be a sprinter, even in my heyday. There's another St. Louis story that I wanted us to hit on, Stephen. So this one is the Bank of America Plaza. Similar story to the previous one. This is one that I think highlights our ability to identify things in real time. So this is one we've talked about for some time. I think we first mentioned this deal about 15 months ago. We noted that Bank of America was looking to sublease about 2/3 of its space in the office. Later, the bank moved about 110 workers from their wealth management arm out of the property. Fast forward, now the August special servicer notes say the second largest tenant will vacate when the lease ends next summer, and that the borrower does not intend to continue funding the shortfalls. So this is a 730,000 plus or minus square foot office building at 800 Market Street. Treehouse Foods is the second largest tenant, about 19% of the space. They're going to be vacating. Bank of America is listed as a top tenant. They occupy about 30% of the space, but their lease ended in June. So it'll be really, really interesting to see, if the borrower stops continuing to fund shortfalls, if these tenants move out as expected. Given that we've seen no origination and no other activity in the market, this is definitely an asset that the lender doesn't want back. But it may be one where the borrower tosses the keys back and says, we're not going to continue to do anything here.
And we also saw a story in Houston about the value of a large office that was cut by almost 60%.
So last month, we noted that special servicer comments for the $465 million Greenway Plaza loan were not encouraging. The comments indicated occupancy at the collateral continued to slide, and the borrower would not continue funding any CapEx or leasing costs absent a restructure. So this month, the story took another negative twist as the value of the collateral was cut by almost 60%, and the value is now below the loan balance. So the collateral for this consists of more than a dozen offices in a 4.5 million square foot Houston complex. This backs a 2017 securitization. So last month, the special servicer rejected a verbal proposal, issued a default notice, filed receivership proceedings, and is awaiting the court's scheduling of a hearing. Since then, the borrower agreed to consent to a receiver, and the special servicer is currently awaiting the judge's signature on that proposed order. So this is, I think, very, very negative to see that basically it's an impasse. The borrower is more or less just showing that they're not going to be committed, and I have, I think, strong expectations about what they want to see. So it's not encouraging at this point. It's not over yet, but it's certainly not a good sign.
I think this is one of those that you would say the writing is on the wall, probably has been for some time. This shows you how quickly the market shifts. When this deal was issued in 2017, this was a fairly conservative deal. I mean, it was a very stabilized set of office buildings in a great part of Houston. Good LTV, good debt service coverage. This was a nice deal. And here we are several years later. I mean, not that many, 6 years later, effectively, where everything is turned upside down. And now this has gone from bad to worse. And so one thing I know about the Houston office market, though, is that it always rebounds. So, this is the craziest market. You might see things trade for, basement bargain prices, and literally 9 months later, they're selling for crazy high prices. This is an interesting one to keep an eye on because, as you mentioned, Stephen, it's such a large, complex cluster of buildings, 4.5 million square foot spread over multiple buildings. So we'll see if they parcel some of them off and sell them off. If they keep all of them, if they try to sell it as a package, we'll see what happens. And obviously, you'll be the first to know if you're listening to the TreppWire podcast or subscribing to any of our products or our TreppWire newsletter.
So we talked a little about multifamily comps. We also saw an industrial comp this week.
This one's interesting. This one's from Windsor, Connecticut, as reported in the Hartford Business Journal. Amazon Occupied Fulfillment Center, this is located at 200 Old Iron Ore Road, has been sold for $122 million. Property is about 1 million square foot, which seems to be the norm for those Amazon fulfillment centers. Sale represents about $122 a square foot. The buyer in this transaction is Winstanley Enterprises. This could be an indication that the industrial market's cooling a bit because the same property sold for $106.5 million in 2016. 2023 sales price shows about a 14.8% appreciation over the last 7 years. Nothing to write home about, but probably seeing some of the impacts of a shorter duration on the lease term and so forth impacting the sales price. These are not typical market transactions in the purest sense, and that they have long-term leases in place. And in this case, there's not a whole lot of alternative users for this type of space, especially in a market like Windsor, Connecticut.
So wait, Lonnie, you're telling me that cap rate, might actually be a factor now for industrial? I mean, higher rates could actually mean something for cooling sales? This is amazing. This is breaking news.
Yeah, so I think we're starting to see the ramifications of this higher interest rate environment, the pullback in Amazon's growth trajectory, and a consolidation across some of the industry players in the industrial space with Prologis, Blackstone, and others making large-scale transactions. So yeah, I wouldn't be surprised if you start seeing some broader slowdown across the industrial segment. And it's due. I mean, if you look at rent growth, cap rate compression over the last 5+ years, it's been unprecedented in this space. And so I wouldn't be surprised if you start seeing cap rates inch up, sales prices inch down, and some people that were super bullish on this market maybe exiting while they still have some positive equity in the deals.
This makes me think of one additional thing I thought was worth throwing out here is in the fourth quarter, we have the CHIPS Act money coming into the market. Do you have any thoughts on what we might see out of this, new influx of cash in the industrial space, whether it's from data warehousing, industrial? I mean, there's a lot of potential for that money to reignite some fires that had been burning a little bit low.
Yeah, I think that's the hope, is that creates some additional, impetus for people to transact in this sector or continue to build or continue to invest. And so I wouldn't be surprised from that perspective if we see a slight uptick in some specific use cases and specific developments. But I think as an overall sector, we've probably hit peak in industrial. And I think on a broad base, we're going to see a slowdown or maybe just a leveling off for sure.
Can't help but wonder if there's going to be any knock-on effects, positive, negative, or otherwise, with what's going on in China.
Agreed.
And in retail, today we saw some buzz on Twitter from Dan McNamara and others about a new development to a Puerto Rican mall loan. So let's jump into that. And as an aside, I cannot get used to saying X instead of Twitter, so I will always call it Twitter.
It almost feels like you're saying something dirty with just calling it X. Fairness, I was reading about this last night. He's been pushing for this name for a long time. I didn't realize that he actually wanted to make PayPal under the umbrella originally for X.com. So yes, this was a mall loan for a pair of 2014 CMBS deals that's going to pay off at a discount. Now, this was a sneaky one because I was digging through this today. And if you read through the servicer comments, according to what was written that's easily accessible to all of us, you wouldn't have necessarily known that this modified loan that got modified back at the end of 2020 had a discounted payoff allowable. So if you dug deep enough, you would find out that one of the things that was offered as part of this negotiation was that the borrower was allowed to pay off this loan at a discount after August 1st, 2023, without any restriction. And so this will result in about almost a $60 million loss on this loan. So it's backed by 350,000 square feet of regional mall space in Puerto Rico. Urban Edge Properties announced that it obtained refinancing through a new 10-year, $82 million mortgage loan. So this was able to trigger the discounted payoff of $72.5 million that had been negotiated back in 2020. So this property had lost both anchor tenants, Sears, which owned its space 138,000 and change, and Kmart, which had occupied just under 123,000 square feet. It's encouraging that this was able to be refinanced. Obviously, must have been a core asset, good location, still good foot traffic, and some positive prospects, but certainly will result in some pain. And so the non-rated tranche on one of these deals is going to get completely wiped out, and we should see losses eat up into one of the first loss bonds. And the other one, the non-rated tranche, still has enough of a buffer left to absorb all of the losses from this discounted payoff. So this is going to be one where traders will be treading very carefully over the next month and trading these bonds, since we're not exactly sure on the timing and precise amounts, but certainly this is a positive and a negative.
Yeah, anytime you mention Kmart and refinancing, you kind of have to do a double take. Interesting story here out of Puerto Rico. We don't talk about Puerto Rican transactions too much, but we do track data in Puerto Rico, and we have quite a bit of it, actually. So if this is of interest to you, reach out. I'd be happy to share some info on this. And just back to the Twitter stuff, I'm Team Haley on this. Like, it's got to be Twitter. If you pay for the subscription, it actually shows up as X Premium. So to Steven's point, just a little weird.
And what are they calling tweets now? Did they come up with a name for that? I think it's repost now instead of retweet, but
yeah, I think they made it super bland. It's like we're posting and reposting.
Yeah.
It's so 2017 or something.
And we had another retail story about an Ohio mall that is close to being sold.
Yes, we have August special servicer notes for the $106.4 million mall at Turtle Crossing that states the purchase was awarded to the highest bidder, and closing is expected to occur in the third quarter of 2023. So the note was sent to special servicing in July 2020 and has been delinquent for the last 3 years. The collateral contains 385,000 square feet of inline space in the Dublin, Ohio mall. The entire mall totals 1.1 million square feet. In 2022, the debt service coverage ratio was under 1.02 when occupancy was 88%, and the collateral was valued at $240 million back in 2013, but the value was lowered to $80 million in 2020, then $48.4 million in 2021, and then 29.2 in 2023. That was a very rough decline. Good to see this mall is finally getting resolved, but this is a dramatic drop in value. Not a great story, but at least we're getting some resolution finally.
Yeah, this reminds me, I saw a story this week of some Delta Airlines passengers that had to get stretchered off of the airplane because they hit some rough turbulence. And I think the owners of this mall are probably feeling that same type of symptoms relative to the trajectory of this asset. So it's not great, and we don't want to make fun or take it lighthearted that this is real money that people are losing. But the reality is, we're going to see more of these malls that fit this criteria that are currently out there than probably on the other side of it. So not great news for the Ohio mall folks, at least in this market. And I wanted to say, Stephen, I think your Texas roots were coming out. You called it Turtle Crossing for Turtle Creek in Dallas, but this is actually Tuttle Crossing. So that was a Freudian Texas slip, I think.
I think it was.
And we have a quick hit for our hotel story this week. We saw a stake in the Bellagio Hotel and Casino sold.
Yeah, so this is an interesting story. The property value based on the percentage interest sale pegs this at a significantly higher value than what the property traded at in 2019. So when this property was securitized, the Bellagio Hotel and Casino back in 2019, the appraisal at the time valued the property at $4.26 billion. This recent transaction was Blackstone shedding a 22% stake in the property. And if you gross that sales price for the 22% up to a full fair market value of the asset, it would pegged at about $5.1 billion. So pretty significant increase if you extrapolate that out over the asset. Property backs, a single asset deal was 1.9 billion Blackstone 2019 deal. Also pieces of the loan spread across some 2020 conduit deals. It's about a 20% appreciation in value. It should, make CMBS investors even more confident in the underlying asset. There was probably some questions coming into COVID and coming out of COVID of how these casinos and hotels would actually play out into the future. And I think this bodes really well for the resiliency of people's willingness to go to a location and gamble their money, stay in nice, expensive hotels. So great deal for Blackstone. And these are really interesting. If you're a client of ours and you dig through the docs on this, the way they break out the overall value and component parts between the casino and the gambling aspect, and then the rooms and the restaurants and everything else, these deals are really complex and there's a lot of moving parts. And it's for deal junkies like us, Stephen, pretty interesting and pretty cool data that we can see and actually start to analyze at a much more granular level on these.
Absolutely. I love looking through these because it makes you appreciate the complexity and amount of sophistication it takes to manage, to broker, to do anything in one of these deals. And I will say Las Vegas has had some absolutely phenomenal momentum on the convention scene. They kind of have really been a winner from what's been lost from San Francisco on the convention circuits. And then we also have, like Taylor Swift and Formula One that have been resoundingly positive. Even Adele has been driving, some traffic on the margin. So there's a lot of, positive news for Las Vegas. And I think this is probably a really good play by Blackstone for what they're able to do here.
I wonder, Haley didn't mention, but maybe Manus is in Las Vegas trying to secure us a residency this week. And that's why he's not on this week's pod. But maybe more to come on that, coming at you live from the Win, the TreppWire Podcast. I think that has a pretty good ring to it.
The question of the week, is Manus rolling in the deep?
So we have two more stories before we close, a quick hit in office and then a breakdown of what we're watching in the student housing market.
Yeah, so we wanted to circle back. We weren't going to get into detail on this office story, but we wanted to highlight that a loyal listener had sent us a deal that they just closed on in Nashville. And if you're a listener and you're doing deals, you should reach out to us. We'd love to partner with you and see how we can bring those to life here on the podcast. In this particular instance, Canyon Partners and JP Morgan provided $175 million in a recapitalization loan for the 122-1 office tower in Nashville. So if you want to see more on that story, it's on the RE Business Online. And you can check it out. And we appreciate the listeners sending us in some success stories from their firm in the office space.
So just a quick plug to tease a piece that our research team is putting out this coming week after Labor Day. We did a back to school special on student housing where we looked at the top and bottom 10 performing student housing markets in the US. Some really interesting takeaways. Very timely, certainly if you have as much passion for your alma mater in college football as I do, given that we have that starting back up. This should be a fun one just to see where schools, their towns fell in the rankings. Just some high level takeaways. What we saw was that there were some interesting enrollment trends that have bucked what we've seen across the board in higher education of, does higher spending outlays and this enrollment growth have a limit? And the answer is yes. And certainly the fiercely competitive student housing market is one that's always interesting and fun to roll up your sleeves and dig into what's driving the fundamental performance there.
And newsflash for those listeners that aren't familiar, Stephen's alma mater is University of Georgia. So it's easy to root for your alma mater when they're the number one team in the country and have won a couple of national championships over the last few years. I don't know if everyone knows this, though. Stephen may have tried to walk on as a kicker, but I don't think that went as he had planned. It's hard to kick field goals in cowboy boots.
It is. I mean, I tried. What can I say? I was a better racquetball player than I was a football player. I briefly turned pro in racquetball.
No, I did not know that. And I would say that I did not turn pro in racquetball nor college football or anything else. And so if you got some photos, Haley does a really great job of posting those on the interwebs, and we can make you Twitter famous for your pro racquetball headshot.
Yeah, just to bring back my sound effects, wah, wah, wah. I flamed out in warm-ups. It turns out I herniated my disc. You only get 5 minutes to warm up. And man, that was a brief stint. True story, by the way, folks. True story.
So let's turn to shout outs. Cody L said he wanted to give us a big shout out. He's been a fan for over a year. He also wanted to know what it would take to get Lonnie to speak for them in Houston. And I think if you guys listened to last week's episode, Manis joked that it might take some Dyson accessories because Lonnie is a big fan of their vacuums.
Huge fan of the Dysons.
Tracy was the listener who sent us that office story that Lonnie mentioned. So as a reminder, send us your stories, send us ways you want to work with us, and we're happy to do that. Jeff W. is a loyal fan of ours who posts often and shares great content on LinkedIn, so a shout out to him. James G. said he listens to 2 pods, TreppWire, and Conan O'Brien Needs a Friend. So he's trying to see if we can get Conan on our podcast, and that would be a dream come true of his. I don't know, maybe someone out there has a connection. Let us know. Matt M. sent me a comment and said, thanks for letting the boys know that the ketchup is sealed for freshness, not for shrinkage. So listen back to last week's episode for more on that. Roy R. tagged his friend Tor E. in our Bob Knackle episode and said we have to listen to this one. We got a lot of great feedback on that episode. Bob was an incredible guest, so if you haven't listened, go back to episode 212 and check that out. And we also had some people on Twitter saying 212 was perfect because it's 212, which is the area code of New York City. A few others on the Bob Knackle podcast. Kevin W. said, fantastic pod. Lewis B. said, you guys rock. Love the interview with Bob. Chad C. and Revan Capital on Twitter said, great podcast on the importance of data and specialization. Chad also sent us an example of an office to residential conversion. And Tom Interbobby on YouTube said, Bob is a legend, which is what we wrote in the title. So we agree. A few others from this week, Jason J., Eric C., Debbie D., Mark E., and Aaron W.
So as we enter the Labor Day weekends, we have the U.S. Open going on. Since we've brought up UGA a few times, I just got to give a shout out to a former dog who's retiring after this year's U.S. Open, John Isner. Go for it, man.
Yeah, interesting story. As pod listeners know, I travel frequently. I'm in New York quite a bit since that's where our corporate office is. And about 3 years ago, I actually was staying at the same hotel as Coco Gauff. And so it was really interesting because she had just kind of burst on the scene maybe a year or two before that. Seeing her and her dad like walk down out of the elevator was a really kind of surreal moment. And to see how she's developed now, I mean, she's powerhouse for sure. So U.S. Open, if you're not able to see it in person, still great TV. Just incredible how athletic and talented these tennis players are. And so maybe if you can get the back fixed, even can't come back for racquetball, but maybe you can make a comeback for some pickleball or some tennis.
You know, I think this weekend I'll be doing what many other people are doing, trying to relax, have a beverage, a burger, a dog, and watch some U.S. Open. Maybe some Formula One too.
Sounds great. Enjoy the long weekend all. And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.